pretty good start, 50 points in the green. The Sensex is up 150 points.
But the frontline index is quite flat right now.
0.4% higher on the mid-cap index, and that's outperforming the benchmark right now.
It's just about a 0.25% gain on the Nifty. The index hasn't moved at all. The pivot has been 18,600, and we've been around that level for the bulk of the day. The Nifty looks all set to retire around the 18,600 mark for the day. Just about a 0.25% increase coming in on that index. It was a bank Nifty that kind of was quiet and was being a bit of a spoil sport for the bulls all throughout.
Hello and welcome to Markets Today, the show where we track about 6 hours of the day's trading action in just 5 headlines. I'm Meekta Batra. Here are the top stories for this evening. The Sensex and the Nifty are flat after what is a range-bound session. Financial stocks underperform. The mid-caps fare better than the blue chips, with the index gaining close to 200 points. Financing arm TVS Credit gets a fund infusion from Premji Invest, even as the company buys the residual 25% minority stake in its Swiss e-mobility subsidiary. Brokerages give the deal a thumbs up. SRF and Navin Fluorine dip following May export data. Even pharma stocks like Divi's, Loris Labs and Gland Pharma trade soft on weak data, but Lupin and Syngene gain on a strong showing. Oil marketing companies rally as brokerages see a fall in marketing losses. HPCL gains over 4% and BPCL gains over 3%. IOC also ends 1% higher. Go Fashion declines 5% after Sequoia Capital sold more than 10% stake in the company. Sequoia is likely to have raised more than 600 crores from the stake sale. Well, on to the first headline this evening then. The markets ended near the flat line as financials continued to underperform. Nifty and the Sensex ended flat, but with a slight positive bias. The Nifty Bank ended mildly in the red, but the mid-caps outperformed. That index ended up over 0.5% in the green. Prashant Nair is here with the details.
Well, for large cap indices, it was a quiet day, quiet start of the week, but there was no stopping the mid and the small cap part of the market, which kind of took off from last Wednesday. Remember, last Thursday and Friday, we had a bit of a pullback, 1.5% in that range. But today, I mean, there was little evidence of that. We kind of started higher, at least in the broader markets, and kept going higher through the course of the day. I'll get to stocks in just a bit. Banks, the bank index was absolutely flat. Almost 1% gain on the small cap index, a little less than on the mid cap index as well. Large cap gainers coming through in names like BPCL, HCL Tech and Infosys. So, I mean, it was a fair mix. There were stocks lower as well, but nothing large, limited to about 1.5% cuts on the Nifty stocks. Now we come to the broader markets. Advanced decline was not outrageously positive. Some 200 stocks separated gainers and losers, but the list of volume-led gainers was much longer as compared to stocks which went down on volumes, and that has been true for many, many days now. So consider these stocks: Suzlon, Reliance Power, KPI Green. I mean, big volumes, big gains. Nuclear software continues to do very well. CMS Info lost 6% yesterday, came back about 5% today. The textile companies have been rallying: Gokuldas, Himmat Singka, Indocount, auto ank names, Jai Bharat Maruti, Lumax Tech, shipbuilders like Cochin, Garden Reach are continuing to rise, and there was a Newland Laboratories which was higher as well. There were losers as well, but as I said, the list of stocks which went down in volumes is shorter. Go Colors, SRF, Greenlam, KRBL, Triveni Turbines, a Precall, a All Cargo, perhaps is what I want to put out in terms of what was down today in the broader markets. Now, the Nifty has not done very much today. The supports for the Nifty come in around the 18,500 zone, which is around 100 points away from where we left off. And there are event risks this week from global markets. You've got many big global central bank meetings. The biggest, of course, is the FOMC. Tomorrow, we get the CPI numbers out of the US. And then on Wednesday, we get the US Fed decision, which we react to on Thursday morning. Back to you.
Okay, yes, absolutely, Prashant. Well, it's going to be a heavy week in terms of cues. But in market opinion, Hiren Ved of Alchemy Capital Management expects margins to continue to recover in the first 2 quarters of FY24. Going forward, he is bullish on the mid caps as well as small caps.
If you look at the fourth quarter numbers that the earnings season just got over, I think broadly the non-financial companies have clawed back about 150 basis points of those margins back, with a combination of the fact that raw material prices have started to soften, and companies may also have taken some price hikes. And I do believe that this trend will continue into Q1 and Q2 as well, because we are not done. I think commodity prices continue to soften, and I think the full benefit of that will flow through into Q1 as well. There is no doubt that the breadth of performance has improved, and the breadth in the market has also improved substantially. So we are very, very bullish on small and mid caps going forward from here. I think this is just the first leg of re-rating after a long consolidation and correction.
Okay, well, on to the second headline now. TVS Motors gained after its financing arm TVS Credit Services 480 crores from Premji Invest. Separately, TVS Motors has also announced that it will acquire an additional 25% stake in its Swiss e-mobility subsidiary. Sonia is here with the details.
Well, thanks a lot for that. As you rightly pointed out, TVS Motor is buzzing in trade today. The stock is at a fresh lifetime high. The stock is up almost 30% in 2023. There are, of course, several positives going for TVS Motor, but today we are focusing on two such. One of them, of course, as you rightly pointed out, is that TVS Credit Services has got almost a 500 crore equity infusion from Premji Invest. Now, it is the captive financing arm of TVS Motor, and there are two positives in this. One, of course, there's value unlocking, so that is a positive. The other thing is that now TVS Motor will have to, can stop funding the TVS Credit Services business. So that will give TVS Motor's balance sheet a bit more strength. If you remember, in FY23, all of FY23, TVS Motor has invested almost 500 crores in the TVS Credit Services business. So now that they're getting external funding, the funding internally will stop, and that's a positive. Now, BofA Securities and Macquarie have aggressive target prices. BofA Securities has raised their target price to 1,500 from 1,300 earlier. Macquarie has a target price of 1,400 plus. Macquarie says the stake sale values TVS Credit at over 7,100 crores, and which is equivalent to about 96 rupees per share for TVS Motor. Now, the other news flow that we're looking at is TVS Motor has acquired the remainder 25% stake of SEMG, which is its Swiss e-mobility arm. Remember, it earlier had bought 75% stake, and now it's completed that acquisition. So SEMG is now a 100% subsidiary of TVS Motor. Now, why is this important? Because SEMG, as I said, is a Swiss e-mobility business. What they do is they buy e-bikes from manufacturers and they sell it to the end consumers, both in the B2B and B2C segment. Now, this is important because, they are present in spaces in Europe like Switzerland as well as Germany. They, in fact, have 30 retail stores across Switzerland and Germany, and they have $100 million of revenues up until now annually. So it is a very strong business. Now they've completed the acquisition, which cements TVS's space in the global e-mobility business. And of course, it's part of their growth strategy there. Back to you.
Okay, all right, Sonia, thanks very much for that. Well, on to the third headline today. Pharma stocks like Divi's, Laurus Labs, Lupin, amongst others, gained today. This was on the back of pharma export data. So, for example, we did have export data for the month of May as well as for Q1 of FY24 on a quarter-to-date basis. Now, so for example, Lupin saw export data for the month of May, which was strong at around $67 million versus $41 million on a month-on-month basis. For Syngene, stood at around 12 million versus 8 million on a month-on-month basis. And remember that they did see, Syngene probably did see some benefit from supplying to the animal health company Zoetis. Now, exports with regards to Divi's Labs were a bit weak on a Q1 FY24 till date basis. So exports were at around $89 million. This compares to $200 million Q1Q, $250 million on a year-on-year basis. Laurus Labs was also weak at close to around 40-odd million versus around 128 million on a year-on-year basis. But remember that they did have the benefit of Paxlovid generic, so you have to adjust for that. Gland Pharma exports at $37 million versus $82 million on a Q-on-Q basis and $80 million on a year-on-year basis. So overall, there was positive monthly data for Lupin as well as Syngene. Highest monthly shipments for Lupin. For Syngene, the momentum was really led by Zoetis' animal health product. And for Q1 FY24 till date, the likes of Divi's, Gland and Laurus were a bit sluggish. But apart from the May export data, we had Gland Pharma, which was also in focus on account of a US FDA inspection. So I did pick up from my sources that one of their more important plants, which is an injectable facility in Hyderabad, is going to be inspected by the US FDA starting at the end of this week, which is on the 15th of June. It is going to be a current good manufacturing practice inspection, which is basically a routine inspection, as well as a PAI inspection, which is a product-specific inspection. So that means that the US FDA will be inspecting the plant to see if it's in order on a general basis, as well as whether they can supply 7 products going forward from that plant to the US markets. Remember that the Gland Pharma as a company supplies around 70% of their sales to regulated markets, and hence this particular inspection would then gain importance in that context. But that's on Gland Pharma. In more stock-specific news, a bunch of specialty chemical stocks were under pressure on the back of their May export data. Sunil is here with the details.
Well, largely it's negative in the month of May is what the export trend is looking like for the specialty chemical space, barring a few of them, of course, and those are reacting positively in trade today. Let me start with Aarti Industries. It has been a decline on a YY basis, 46% down in terms of exports for the month of May. They have spoken about weakness in their discretionary portfolio, and that seems to be putting some pressure on their numbers. For Aether Industries, they have a big exposure to exports, close to 69 to 70%, and both on a YY and on a month-on-month basis, it is a decline. Alkyl amines, on the other hand, stood out with 29% increase in exports. Anupam Rasayan, again, the other one which has an exposure to the European markets, saw a decline of 79 to 82% both on a month-to-month and on a YY basis. Atul Limited was lower. Archean Chemicals, which is the newly listed marine chemicals industry, that is the one which did well this time around. Balaji Amines saw a decline on a YY basis. Clean Sands was the one which saw a decline. Deepak Nitrite again has a sizable exposure to exports, saw a decline here. PI Industries, on the other hand, really stood out, and that's some positive rub-off that we are seeing on the stock as well. Exports is a bigger chunk. It has been outperforming on exports for the last couple of quarters, and that seems to continue in Q1 as well. If we look at Lakshmi Organic, it is lower on a YY basis, but some improvement on a month-on-month basis. The likes of Naveen Fluorine did really well, 44% higher there. Their HPP project will be fully commissioned here. They will cater to Honeywell, and that is a big chunk of the exports, which seems to be doing well for them. We have Sudarshan Chemicals, where the company did speak about the improvement that they are seeing in exports. FY24 will be driven by exports as well, and that seems to be working well. SRF, surprisingly, a decline both on a month-on-month and on a YY basis. So more declines than gains is what we have seen in the month of May, and it will be an important factor to track for chemical companies.
Okay, all right, Sonal, thanks very much for that. PI Industries, in fact, gained over 3% after its largest customer reported a 23% year-on-year growth in the agrochemical revenue for November 2022 to April 2023. Sonal is still with us to tell us more about this particular stock.
Thank you so much for that. Well, PI Industries is in focus because one of their largest customers, which is a Japanese company, Kumiai, has reported a 23% growth in their first half of FY23 numbers. That is the agrochemical numbers. So basically, that is from November 2022 to April 2023. They follow the October financial year as their annual year for reporting numbers. This was fueled by a particular sale of particular product sale, and that is pyroxysulfone sales. Now, they have also raised their earnings forecast for FY23 on the back of good numbers that they reported in first half itself. The growth was 42% for this particular product. They had earlier guided for a growth of around 34%. So this one product is doing very well for their largest customer, and that is something which is fueling the rally that we are seeing in PI Industries. There is a note from Equirus where they say that a good show and earnings guidance increase bodes really well for PI Industries, because this implies there is no inventory build-up for this particular product. Now remember, we have spoken to a lot of agrochemical companies. UPL, for instance, said that globally there is a huge inventory build-up in agrochemical products, but that does not look like the case after this positive commentary from the Japanese agrochemical player, and that is something which bodes well for PI Industries, and that is something that they said post their conference call as well. No big inventory build-up, particularly for that company, and that is something which is fueling the rally that we are seeing in PI Industries today.
Okay, all right, Sonal, thanks very much for that. That's PI Industries. Time for a short break, but before we go, here is some more market opinion coming in from Lawrence Balank of CLSA. We'll be back with more.
you look at the absolute price action for the Nifty mid-caps, this is the first of the key indices that we track in India that's cleared through the highs that you made back into 2021 as well as 2022. So we've got a sort of confirmed breakouts with the momentum indicators rising with that. So we think at a minimum we've got 13% upside, but we have upside targets extending towards sort of 24% type gain. So we think that that's an important breakout that we've seen in the broader market. And then if you're looking at the mid-cap index relative to the top 50 stocks, you've seen that relative price action breakout of a 18-month consolidation pattern. So basically it just has the mid-caps as the leading part of the Indian market. We've got the Indian bank sector, which is testing its highs from late 22, and we've seen some slowing upside there. So looking for a bit of a pause in the Indian banks. And then if you look at the other large cap sector being the IT sector, that's still in the trading range post last year's 30% decline. So taking those two major sectors into account, it looks like the Nifty will battle to get through this 18,800 area in the short term. So look for more of a consolidation pattern there while mid-caps continue to gain the attention.
Welcome back. You're still tuned into Markets Today on CNBC-TV18. Well, on to the fourth headline this evening. Oil marketing companies rallied between 2 to 4% on the back of a positive commentary coming in by the likes of JP Morgan and Motilal Oswal. Sonal is still with us, yet again joining in with the details.
Thank you so much for that. Well, a couple of positive brokerage notes on the entire oil and gas space. I picked two of them. They specifically speak about oil marketing companies. First, of course, is JP Morgan, where they speak about Indian refiners being very profitable right now, which compares to be higher than the benchmark GRMs as well. However, they think that retail fuel price cut is still some time away. They do not see any price cuts immediately. That is because the OMCs will be recouping the large losses that they made in FY23, and that's the reason they will not be passing it on to the customers as per JP Morgan. They broadly see a positive earnings environment for all the refining players, including Reliance Industries, and their top picks are Reliance Industries, HPCL and IOCL. Motilal Oswal also has a positive note on the oil and gas space. They say OMCs had kept retail prices unchanged since 6th April 2022, and that is the reason they had huge losses both in the petrol and the diesel segment. But now, since then, Brent has moderated to levels of $79 a barrel, and declining crude prices will bode well for oil marketing companies, where now they're actually making huge profits in both their petrol and diesel segment, around 10 rupees in petrol and 12.5 rupees in the diesel segment. So that definitely is boding well for these companies, and that's why they're positive on the space.
Okay, all right, Sonal, thanks very much for that. Let's shift focus now to the insurance space. Life insurance companies have released data for the month of May reflecting a premium contraction of 4% on a year-on-year basis. Yash Jain is here with the key numbers.
Well, Ekta, 2 months into FY24, and for both those 2 months, LIC's numbers have sort of dragged down the overall industry numbers. As far as the life insurance industry itself is concerned, in the month of May, the premium, as you rightly said, contracted by about 4% on a year-on-year basis. If you look at the first 2 months put together as well, the premium is down about 15% on a year-on-year basis. Private life insurance companies, though, have performed relatively better, growing at 9% both for the month of May as well as for the first 2 months of FY24. Now let's speak about the drag that is LIC. For LIC, the May premium was down about 11% on a year-on-year basis. For the first 2 months of financial year, it is down about 28%. May retail APE for LIC is also down by about 1% on a year-on-year basis. Another pain point for LIC has been the market share. LIC has lost market share of about 746 basis points so far in FY24 on a year-on-year basis. For HDFC Life, the numbers were strong. May premium grew by about 26% on a year-on-year basis. FY24 so far also has been good. The premium growing at 14% on a year-on-year basis. May retail API also saw a growth of about 10%. ICICI Prudential Life Insurance in the month of May, the numbers were weak. May premium was down 19% on a year-on-year basis. May retail APE was up 4% on a year-on-year basis. Now next is Max Life Insurance. Strong numbers for the company in the month of May. May premium growing at 16% on a year-on-year basis. The first 2 months of FY24, the premium is up 9%. Also, May retail APE saw a growth of meager 2%. As far as a year-on-year comparison is concerned. Finally, the strongest company out of the private sector, SBI Life Insurance, the May premium saw a growth of 58% on a year-on-year basis. The first 2 months for FY24, the growth has been again strong. The premium has grown by about 36% on a year-on-year basis. And finally, May retail AP, that too saw a growth of about 8%.
Okay, all right, Yash, thanks very much for that. That's on the insurance space. But on to the fifth headline today. Go Fashion declined nearly 5%. This is after Sequoia Capital sold around 10% stake in the company. Vivek is here with the details on this story. Vivek.
Well, absolutely. Earlier today, prior to market open, we highlighted and, we had alerted to the fact that there was going to be a very large block deal as far as Go Fashion is concerned. More than 10% of the equity has changed hands along expected lines. Now, we had access to the term sheet yesterday, and as per our sources, what we understand is that Sequoia Capital that held 10.18% stake in the company at the end of the March quarter has completely exited their stake. It's a clean out trade from Sequoia Capital. So now after this particular block deal, they won't be having any stake left as far as Go Fashion is concerned. The floor price at which this particular block was set at was 1,135, which led to a total block of close to a little over 620 crore. A large block deal, likely seller being Sequoia Capital. It's a clean out trade from them. It'll be interesting to see who the buyers are once, the block deal details come out, post-market hour on the exchanges.
Okay, all right, Vivek, thanks very much for that. Well, before we wrap, here's an in-depth analysis on housing finance companies. Most of them have seen a good growth in the past years. Abhishek Kothari is here with a report.
Well, housing finance companies have seen robust growth in their AUM in last 3 years. There has been a huge differentiation between the men and the boys. SDFC Limited has seen robust AUM growth. So the impact from COVID, all those who had seen robust momentum and growing faster than the system growth rate till FY17 and 18 bore the brunt of fast rundown of their books. Hence, clearly, there has been a huge differentiation between the quality amongst lenders. Not to forget that some of the small-sized companies have done robustly well, like Aptus Value Housing, which has seen its loan book double in last 3 years. Home First Finance also has doubled its loan book in last 3 years. And Aavas Finance has seen a growth of around 82% in their AUM in last 3 years. Indiabulls Housing Finance as well as PNB Housing Finance, they have seen their AUM decline in last 3 years. So Indiabulls book has actually declined by around 27%, while PNB Housing Finance book has declined by a little more than 20%. Incrementally, the growth of SDFC Limited in last 3 years is 2x the entire listed HFC sector in terms of value-wise AUM growth. Net interest income growth was around 18% YOY and about 7.6% quarter-on-quarter. This growth was led by strong growth seen in LIC Housing Finance, SDFC Limited, Home First Finance and Aavas Finance. The only company to see a decline both YOY and quarter-on-quarter in NII was Indiabulls Housing Finance, while sequentially the NII declined for PNB Housing. Operating profit growth was at 15.3% YOY and around 10.7% sequentially. Strong operating profit growth was seen for LIC Housing Finance, SDFC Limited, Aavas Finance and Home First Finance. PNB Housing Finance operating profit declined both YOY and quarter-on-quarter, while Indiabulls operating profit actually declined on a sequential basis. Net profit for the HFCs grew by 17.4% YOY and about 28% quarter-on-quarter. SDFC Limited led the growth this time around with nearly about 20% quarter-on-quarter growth in terms of profits. LIC Housing Finance profit growth was seasonal in nature, while Aavas Fin and Canfin showed good growth on a sequential base in terms of their earnings. AUM growth was a bit on the lower side for the companies, growing at around 10% YOY and 3.5% sequentially. take the loan growth with a pinch of salt, as tenure has increased for the loans with lower repayment in EMI and higher repayment in interest in the EMI mix. Asset quality has improved, with gross NPA being down 19.7% YOY and 13.5% sequentially. Declining gross NPA was led by HDFC Limited, which saw its gross NPA decline by 30.4% YOY and about 18.25% on a sequential basis. PNB Housing also saw improvement in its asset quality as well. Gross NPA is the lowest for Canfin Homes and Aavas Finance, while it is the highest for LIC Housing Finance and PNB Housing Finance, reflected in their valuations as well. So HFCs in Q4 FY23 saw NII growth of 7.55% quarter-on-quarter, operating profit growth of 10.7% quarter-on-quarter, while the PAT growth was robust at around 28% quarter-on-quarter. Net interest margin will improve for HFCs with repricing of their loans in terms of aiding their yield going ahead. So HFCs have battled the liquidity conditions really well, and high cost of funds challenge has also been taken care of. So outlook remains good for the sector, and its return ratios can improve from current levels.